I used to think keeping cash was the safest bet, but in reality, money is quietly losing value due to inflation and unexpected economic shifts. Bank accounts aren't always a secure shelter. If you're also simply holding cash, consider this. This video shares 10 potentially better asset types to protect and grow your finances, trusted by top investors like Mark Cuban and Jack Bogle. Don't let your assets dwindle. Discover smarter options for your financial future. The first asset I learned about was safe haven currencies. Imagine you're adrift in the ocean during a financial storm. These currencies are like a sturdy lifeboat, keeping you afloat and preventing you from sinking. Some prime examples include the US dollar, Swiss franc, Japanese yen, and the euro. These come from countries with strong economies, stable political systems, and low inflation. During market turmoil like the 2008 financial crisis or the COVID-19 pandemic, investors worldwide often flock to these currencies as safe havens. Take Ray Dalio, for instance, the founder of Bridgewater Associates, one of the largest hedge funds in the world. He has consistently recommended that during times of instability, allocating assets into safe haven currencies is an optimal strategy for protecting capital. Similarly, investment tycoon Warren Buffett, during the strengthening of the US dollar in 2020, increased his dollar cash holdings, not to hold, but to wait for opportunities to buy good assets at bargain prices. This is an important lesson to remember. Cash is only temporary. Don't see it as the final destination. Think of it as a vehicle to access more sustainable profit-generating investment channels. Understanding the role of safe haven currencies has driven the search for methods to integrate them into investment portfolios. Because these assets not only help protect assets from unpredictable market fluctuations, but also contribute to preserving the financial achievements that have been made. In times of economic uncertainty, when investors are rushing to sell off riskier assets like stocks or cryptocurrencies, they flock to stable currencies like the US dollar, Japanese yen, or Swiss franc. This causes the value of these safe haven currencies to often rise. And thanks to this, those who own them can ride out the storm and even profit while others are struggling with losses. What's more, these currencies have incredibly high liquidity. You can buy and sell them easily all over the world. They are backed by strong economies and robust financial systems. Holding them in your hands feels like having a shield, thick enough to withstand the rough waves of the market. The question is, how to invest in these safe haven currencies effectively and transparently. There are two notable methods to approach this investment. The first method is through foreign exchange forex trading. Forex trading platforms offer a variety of currency pairs and market analysis tools. Choosing a reputable platform regulated by competent financial organizations is crucial to ensure investment safety and effectiveness. Another option is to invest in currency ETFs, such as the Invesco DB US Dollar Index Bullish Fund, ticker symbol UUP. This fund simulates the fluctuations of the DXY index, which measures the strength of the US dollar against 6 other major currencies. With the advantages of low fees and high liquidity, currency ETFs provide a simple way to invest in strong currencies. Now that we've explored the power of safe haven currencies and how big investors like Ray Dalio have used them to protect their wealth against economic volatility, you're probably starting to get a broader perspective. But if you really want to diversify your portfolio and create a double hedge against inflation and market risk, you can't ignore commodities, an asset class that has been around for thousands of years and still holds real value. The first assets mentioned are those that humanity has always regarded as treasures, precious metals such as gold, silver, and platinum. Beyond their glittering appearance and rarity, they also have high applicability in industry, medicine, and high technology. During many periods of economic instability, from the 2008 financial crisis to the pandemic, gold has often been considered a safe haven for investors. Even Warren Buffett, a legendary investor not particularly fond of gold, once invested in Barrick Gold, indicating that precious metals still hold a significant role in the portfolios of major investors. Next, industrial commodities, the very things that drive the global economy. Oil, natural gas, and coal, despite the ongoing debates about environmental issues, there's no denying their essential role in production, transportation, and infrastructure. The prices of these commodities depend on many factors, from global demand and extraction output to political situations in major exporting countries like Russia, Saudi Arabia, and Venezuela. These fluctuations create opportunities for those who understand the market and know how to seize the right moment. And finally, agricultural commodities, the most essential things for life. Wheat, corn, soybeans, coffee. It may sound ordinary, but remember, a drought in Brazil or a major storm in the U.S. can cause Arabica coffee prices to double. This is why savvy investors never overlook this asset class. A prime example is John Templeton, the American investment master who built some of the top international funds of the 20th century. He made huge profits by buying when the market hit rock bottom and didn't hesitate to invest in commodities like oil and precious metals. Templeton always believed that physical assets were the cushion that protected portfolios from inflation and currency depreciation, and history has proven him right. You can see that despite being challenging, investing in commodities still deserves to be considered a smart diversification method that helps protect and grow wealth. Participation options include commodity ETFs, direct purchases, or futures contracts. However, the key lies in continuously monitoring market fluctuations, balancing capital allocation wisely, and seeking expert advice when needed. In a constantly shifting global economy, owning assets with intrinsic value, essential goods for every country, remains a sustainable strategy. After delving into the potential of commodities as an alternative investment channel, you may well ask whether it is possible to find asset classes that carry both material value and are closely tied to industrial development trends. The answer is industrial commodities: copper, aluminum, zinc, iron ore, crude oil. Not merely raw materials, but the lifeblood sustaining all production activities. Investing in this group offers two standout benefits. First, it connects directly to the growth pace of the global economy. As industries in India, Brazil, or Vietnam expand, rising raw material demand drives prices up. Second, industrial commodity prices often move independently of stocks and bonds. Even when financial markets waver, they can still appreciate, helping reduce overall risk and maintain portfolio stability. Moreover, regularly reviewing asset mix ratios and updating strategies enables investors to optimize returns and avoid over-concentrating risk in a single direction. As a result, the long-term trend and profit potential of industrial commodities become a crucial key to preserving and growing wealth. Many large investment firms don't overlook this opportunity either. BlackRock, one of the world's largest asset management firms, often allocates a portion of its portfolio to commodity futures. Bridgewater Associates, founded by Ray Dalio, also uses industrial commodities to hedge and generate profit during volatile market periods. Moreover, regularly reviewing asset mix ratios and updating strategies enables investors to optimize returns and avoid over-concentrating risk in a single direction. As a result, the long-term trend and profit potential of industrial commodities become a crucial key to preserving and growing wealth. Many large investment firms don't overlook this opportunity either. BlackRock, one of the world's largest asset management firms, often allocates a portion of its portfolio to commodity futures. Bridgewater Associates, founded by Ray Dalio, also uses industrial commodities to hedge and generate profit during volatile market periods. You should explore flexible investment methods. Besides directly buying futures contracts, which allow you to commit to buying or selling commodities at a predetermined price in the future, you can also invest through ETFs that track commodity indices, such as the S&P GSCI or the Bloomberg Commodity Index. These indices reflect the price movements of asset groups including energy, metals, and agricultural products. Additionally, you can choose to invest indirectly by buying shares of companies that mine, produce, or distribute industrial goods, such as Freeport-McMoRan, copper, Alcoa Corporation, aluminum, or ExxonMobil, oil.
For you, this is no longer simply investing, but a way to accompany the world's development. Industrial goods are not just assets, they are symbols of movement, technology, and the future.
You must have been very excited when investing in industrial goods, assets closely linked to the real development of the global economy. But the deeper you delve, the more you realize one important thing. Great opportunities always come with significant risks. The prices of items like copper, crude oil, aluminum, or iron ore can fluctuate wildly, sometimes overnight. A small disruption in the global supply chain, a new government policy, or the emergence of a substitute technology, these are enough to cause prices to reverse course. And without a clear mind, investors can easily get caught in the wild waves of this market. In 2014, when oil prices collapsed due to rising production amid weakening global demand, many investors panicked and sold off. Mark realized that investing in industrial commodities isn't just a game of chance, but demands solid knowledge, a long-term vision, and flexible risk management, constantly adjusting asset allocations as needed. He began to dive deep into supply and demand dynamics, monitoring macroeconomic shifts and international policies that influence prices. Mark learned to analyze industry reports, track manufacturing PMI indices, and take a comprehensive market view instead of merely chasing short-term gains. Jim Rogers, co-founder of the Quantum Fund with George Soros, became his inspiration, as Rogers consistently held industrial commodities as a safe haven whenever markets wavered. From that experience, Mark drew this lesson: every investment opportunity carries with it the responsibility to keep learning, make sound decisions, and safeguard assets for the long haul. After exploring the opportunities and challenges of industrial commodities, we'll begin looking for a more stable investment channel that still delivers steady cash flow. The result is REITs, real estate investment trusts, which have attracted attention, and Alice's story clearly illustrates the path to financial freedom through this vehicle. Alice holds 100 shares of XYZ Inc., a REIT that operates shopping centers in the U.S. and distributes rental income as periodic dividends. When the company announces a quarterly dividend of 0.50 per share, Alice receives $50. For many, this seems like a small amount, but Alice doesn't spend it on short-term expenses. She reinvests it to buy additional XYZ Inc. shares via a commission-free online platform, harnessing the power of compounding. Alice doesn't spend it on short-term expenses. She reinvests it to buy additional XYZ Inc. shares via a commission-free online platform, harnessing the power of compounding. Like Warren Buffett, who believes in reinvesting dividends from companies with long-term growth potential, such as Coca-Cola or American Express, Alice sees REITs both as a stable passive income source and as a bridge between safety and growth. With each passing quarter, she not only receives passive income, but also feels her ownership increase as her share count steadily grows. However, risks cannot be ignored. Dividends are not guaranteed if the company faces financial difficulties and may even be cut. Additionally, tax treatment for REITs varies depending on the fund type and the investor's tax status. Therefore, reviewing a fund's dividend payment history and its financial health before investing is essential. Another notable advantage of REITs is their ability to diversify a portfolio. These funds typically invest across various property types and regions, from shopping centers and hotels to telecom towers and data centers, mitigating risk if any single sector or region experiences a downturn. Legends in the field such as Sam Zell, the king of REITs, and David Simon, CEO of Simon Property Group, succeeded not only by buying and selling assets at the right time, but also by inspiring others with their long-term vision and disciplined strategies. Their experiences show that investing in REITs not only generates passive income, but also teaches patience and effective risk management. Next, have you ever wondered why gold, that shiny metal, captivates so many investors? Simply put, gold is not only beautiful, but it's also a symbol of stability and power that has withstood thousands of years of human history. When currencies depreciate, when inflation rises, or when economies fall into chaos, gold often maintains its value. It is like a solid shield in the midst of financial storms. However, gold is not the only option. There's silver, platinum, and palladium, rare metals sought after for their industrial applications and value, particularly in the production of electric vehicles and electronics. You can invest in precious metals by purchasing physical gold bars or coins and storing them in a safe place. Alternatively, you could invest indirectly through an ETF that tracks gold prices, or buy shares in mining companies like Newmont or Barrick Gold, two giants in the mining industry. Yet, I am not blindly optimistic. The prices of precious metals can fluctuate significantly due to interest rate policies, geopolitical situations, or market sentiment. And if you own physical gold, you also have to consider storage and insurance costs. Nevertheless, with the right knowledge and strategy, precious metals remain a valuable part of a diversified investment portfolio, especially if you're looking to protect your assets from unforeseen fluctuations. After recognizing the power of gold and other precious metals to preserve wealth in a volatile economic environment, I understood that these are not merely shiny objects. They are true tools for asset protection, having proven their value over centuries. While paper money can lose its value over time, gold and other precious metals retain their purchasing power thanks to their natural scarcity and stable global demand. However, investing in precious metals is not a smooth path. Market fluctuations, investor sentiment, and global events can cause gold prices to swing unexpectedly. I remember listening to the sharp analysis of Peter Schiff, a veteran stockbroker and financial expert. He believes that gold is preparing for a major price surge, especially as inflation continues to rise and the Federal Reserve, Fed, finds it increasingly difficult to raise interest rates enough to control the situation. Nigel Farage, a former politician and famous television personality, he warns that currency crises and geopolitical risks could further fuel the demand for gold as a safe haven. Of course, not everyone agrees. Some analysts argue that gold prices may stagnate or even decrease in the near future, depending on interest rates, global fluctuations, and market sentiment. Additionally, owning physical gold means you have to pay for storage and insurance, while investing in mining stocks brings operational risks. I realized that to invest effectively in precious metals, you can't just rely on intuition or fleeting advice. Thorough research, defining clear financial goals, and understanding your own risk tolerance are essential steps. Precious metals are an important part of building a diversified portfolio, but they are not a holy grail that guarantees profits. And then, as I began wondering what the next asset could provide both steady income and growth potential, I found the answer in dividend stock funds. Imagine being a shareholder in hundreds of powerful companies. Each quarter, they send you a portion of their profits. That's how dividend funds work. These funds invest in companies with stable cash flows and a strong history of dividend payments, typically in sectors like utilities, consumer staples, financial services, or healthcare. For example, if you invest $10,000 in a dividend fund holding 100 stocks with a 4% annual dividend yield, you would receive $400 in dividends. But you also need to account for management fees, say 0.5%, which would equal $50. If the fund value remains unchanged, your net profit is $350. If the fund increases by 10%, your total profit will be $1,350. But if the fund drops by 10%, you'll lose $650, not to mention potential taxes on dividends or capital gains, depending on your personal situation. Clearly, investing in dividend stocks offers both stable income and growth potential, but it's not without risks. That's why I always analyze everything carefully before making any decision. And if you're looking for a more stable investment with less volatility, let's step into the world of government bonds, another type of asset that can replace cash but with much higher safety. After learning about dividend funds, which help me maintain steady income while providing an opportunity for asset growth, I began to reconsider the role of stability in my investment portfolio. In a world full of volatility, you don't always need to dive into high-risk investment for profit. Sometimes what I truly need is a solid foundation, and I found that in government bonds. Essentially, government bonds are loans I, as an investor, give to the nation. In return, I receive periodic interest payments and the principal back when the bond matures. This is considered one of the safest forms of investment because it's backed by the creditworthiness and financial strength of the government. Compared to stocks where prices can fluctuate wildly, bonds are like a soft cushion that helps me steady my portfolio amidst market storms. I remember the story of Bill Gross, known as the Bond King. He didn't just make his fortune from bonds, he became one of the most influential investors in the fixed income field. His success came from a deep understanding of the market, discipline, and the ability to analyze even the slightest macroeconomic movements. To him, bonds weren't as boring as many thought. They were an art form that balanced risk and sustainability. The next one is cryptocurrencies. Unlike bonds, cryptocurrencies represent a breakthrough, a disruption, and risk. Bitcoin, Ethereum, and a host of other digital currencies quickly became symbols of a generation of investors who dared to think differently, who dared to lead. These currencies use encryption technology to ensure transparency and decentralization, and despite their extreme volatility, they've generated enormous profits for early adopters. A prime example is Elon Musk, the man behind Tesla and SpaceX. When he decided to invest $1.5 billion in Bitcoin through Tesla, it wasn't just a financial move, it was a statement about the future of currency. That move catapulted Bitcoin to new heights, forcing the entire financial world to reassess the potential of cryptocurrencies as an integral part of modern investment portfolios. But I understand that this field isn't for the impatient or the uninformed. It evolves rapidly, changing daily, and to thrive within it, I need to equip myself with solid knowledge, a relentless willingness to learn, and the ability to take on higher levels of risk. I know there are still many opportunities ahead, and I'm ready to move forward to a type of asset that goes beyond protection, one that thrives amid chaos, where instability isn't an enemy but a catalyst for growth. After exploring cryptocurrencies, where potential comes with volatility, I began to realize that some assets not only weather crises but actually gain value from the very chaos. They don't crumble under fluctuations, they become stronger after each shock. These assets are called anti-fragile assets. You might ask, how can an investment grow during a crisis? But the truth is, if I choose wisely, I can profit from market fluctuations. A prime example is Mark Cuban, billionaire, renowned investor, and one of the sharks on Shark Tank. He firmly believes in the anti-fragile investment strategy. According to him, the most valuable assets are those that can adapt, innovate, and grow in any circumstance. Cuban advises investors to focus on companies with strong growth potential, low debt, and especially a loyal customer base. These are the factors that allow businesses not only to survive, but to thrive every time the market turns. Take Amazon, for example. During the 2008 crisis, they didn't just hold their ground, but continued expanding their ecosystem, laying the foundation for what is now a trillion-dollar empire. And if anti-fragile assets are the answer to instability, index funds are the simple and effective way for me to tap into long-term market growth. Investing in index funds is like owning the entire market with just one smart move. These funds mimic the performance of indices like the S&P 500, which includes the 500 largest companies in the U.S. Without the need to pick individual stocks, I can experience the overall growth of the market at an incredibly low cost. Index funds offer diversification, low fees, and long-term effectiveness, a perfect option for those seeking stability and sustainability. One of the most powerful figures in this field is Jack Bogle, founder of Vanguard Group. He created the first index fund in 1976 and has always believed that most investors will perform better by investing in index funds rather than trying to beat the market through frequent stock trading. According to him, excessive trading not only increases costs, but also leads investors to make poor decisions in moments of panic. His advice is clear: buy and hold index funds for the long term, and don't stress over short-term fluctuations. The core lesson from this journey is, holding cash isn't safety, but rather accepting passive risk. To protect and grow assets, money needs to be in motion and generate returns, moving towards your larger goals. You don't need to be an expert. Start by examining how you're currently using your money and ask yourself if it's taking you where you want to go. Thank you for being with us. Your support motivates us to continue sharing real and sincere values. Please share your thoughts in the comments. We look forward to seeing you in the next content, where we continue to learn and build a comprehensively prosperous life together.